banking on blockchain, lending tokenized assets, and the evolution of capital markets. We have, similar to last panel, we have somebody from almost every level of their panel, right? We have folks from the custody side, the traditional banking side, the tokenization side, the L1 blockchain side. And so I think we're in a very good position to answer a lot of questions. And I'm going to start off with the same type of question that I asked in the last panel to open up, where we were reimagining private markets. Why, much to Brian Moynihan's chagrin, would we move banking on chain? Maybe we could start with you, Mathias.
Well, in banking is about, why are we moving things on chain? It goes back to the very core proposition of the benefits of blockchains, which is that you can transfer anything of value between intermediaries, between two people or entities without intermediaries. On the spot, as long as you have access to the internet. And at the core, that is what banking is. It's helping people transact, it's helping people invest, and if you can do so more efficiently, you can have better products for people because you can cut down on intermediaries, let's take, you can increase speed, you don't have the T+2 rails when it comes to USD or whatever, general fiat international payments, and ultimately you have a better service for clients. So at the very core, I think that's what it is. But it only works when a few things are in place, and that is where we are now moving towards, namely that you have enough relevant players, have regulated infrastructure as trusted nodes to do that, because what does not go away is that a security on-chain is still a security and securities laws still apply. You also need to have both legs on-chain, namely the fiat leg and the asset leg. And now with what's happening in the US with the 180 but also more broadly internationally, all these bits and pieces are finally starting to come together. And so, yes, I do believe that over time, in the next 5 to 10 years, banking will truly move on-chain.
So traditional banking is clunky. The on-chain capital markets seem to be a better option for the future in some form of the current market. And then, I guess, in the world of custody, and tokenization, and I guess this varies depending on the jurisdiction you're in. Where are we? I mean, Carlos, you've been building Securitize for as long as I can remember. And
as long as you've known me.
As long as I've known you, which is never long enough. Do you feel as though it was sort of a J-curve event for what you were doing in the tokenization world, where, I think we all were looking at, tokenized student housing in 2017, and that was going to be our gateway to the tokenized finance world. And really, just in the last maybe 24 months, things have kicked off. Do you feel like we are at a capitulation point that requires an additional, I don't know, okay, call it regulatory bill to uncap and really scale, or are we at a place where you can continue to grow and you think your broader tokenization world, we won't talk about Securitize specifically, but tokenization on the whole has the chance to really take hold?
So I've started the company 8 years ago. So it's been 8 years, out of which
long, huh?
The first 6, not a lot happened. A lot of silly projects, not some of them done by us, some of them done by competitors, but a lot of attempts to bring tokenization to mainstream that didn't happen. And I think it didn't happen for a variety of reasons. One is first, tokenization platforms, technology, licenses, etc., were all very rudimentary, and the TradFi people that have the interesting assets were not interested in coming to the space. And the crypto people also had no interest in anything regulated, and tokenization, for the most part, involved dealing with securities. And as Mathias said, tokenized securities are still securities, no matter what crypto people want to tell you. And they didn't want to deal with anything regulated. And then I think the last 2 years, and especially there's 2 things that have happened in my view. One is BlackRock entering the space, which is the largest asset manager, and their CEO going to CNBC even more frequently than you do, talking about tokenization and saying that this is the future of asset management, and eye-opening, and then not only talking, but actually coming into the space, doing and launching what became the largest asset in the industry in a very short period of time. And then more recently, the new administration basically confirming that as regulated entities, we can use any ledger technology we want, and particularly if we want to use Avalanche, I can use Avalanche, and as far as I comply with my obligations as a regulated entity, what ledger technology I use is not their problem. So I don't think that we need any more regulatory unlock. I think what people are trying to do now is to actually try to get with things that you cannot do with traditional equities that you can do just because you use a different technology, which I tend to disagree with. Ironically, crypto people used to say, oh, we shouldn't be regulated differently because we use a different technology, and now they're saying, oh, we should be regulated differently because we use a different technology. But from a regulatory perspective, there is nothing that needs to really change, and I think the Clarity Act does clarify some things in terms of like, DeFi UIs and stuff like that. And it just basically says tokenized securities are securities that still be regulated by the SEC. You still need to comply with the same rules, so go ahead and do it. So I do think that we've seen a massive growth in the last 2 years. Our company has experienced a massive growth in AUM, revenue, etc. But we're going to see a lot more happen in the next 3 to 5 years.
And now, or soon to be a public company, right?
Hopefully 30, 45 days away.
Congratulations, very good. And then, so when...
And we're going to tokenize our own equity, of course.
Obviously. And then, of course, Copper's going to custody the asset itself.
It'll be on
when the whole world is tokenized, thanks to Securitize, and I have my Securitize tokenized equity, and it's going through the roof, you'll be my custodian of choice. Are you prepared? Do you think the industry, the market, or companies like yours are prepared for the entirety of internet capital markets?
I mean, the entirety sounds
quadrillions that Talia mentioned earlier.
Quite daunting, but I think, if, like Carlos said, if you're prepared to partake in financial markets using a different technology, then you are. So, I think it requires getting the right licenses to deal in the right types of asset classes, which largely most jurisdictions define as money, commodities, or securities, right? There's, I guess, real estate might be some. I don't think that the technology limitations are a problem, and I don't think the regulatory limitations are the problem. I think the real hindrance so far to uptake in tokenization has been use case, because I think there's been a lot of attempts to do things that didn't solve problems that were hard enough to solve in traditional space. And I think what we're seeing now is that because of the tailwinds politically, the tailwinds regulatorily, and the institutions taking over the space, that we're seeing a lot more of those use cases. I mean, I'm not a case study. I am better lucky than smart. I joined on November 5th of 2024. I joined the entire industry that day, and that was...
You timed it well.
Timed it well. Better lucky than smart. But I think the reason I joined, right, the reason I turned from being a crypto skeptic and a blockchain naysayer into a participant in this industry and getting to work with the team at Copper was because I lived through the Lehman Brothers weekend. And I was running a derivatives trading desk then. And the institution I worked for at the time went from having a $200 million exposure to Lehman Brothers on Friday morning when we received collateral from our Thursday night marks to having a $2 billion claim that we filed on Monday. And that was market move that when I watch what we do in crypto now, not we, Copper, but the industry does in crypto, it's constant 24/7 mitigation of credit risk. And I think that ability to not be beholden to COBOL mainframe batch times and processes that are designed for other use cases, the ability to customize your use case for your use case is super powerful, right? I mean, I think if you think about, there's $1.3 trillion of initial margin posted around the world for derivative exposures, and how much of that could be reduced because it's posted there because I have to take a bunch of collateral on Friday because I have no idea what's going to happen on Monday, over the weekend when I show up on Monday. But if you could half the amount of initial margin that's out there, that's $650 billion of trapped liquidity that could be used for capital formation or for lending and leverage and economic growth. So I think that's the real unlock that we're seeing, that people are now recognizing, because the financial institution that is regulated and has to hold capital is coming into the space. I don't know if you guys disagree, but that's what we see.
So you are a blockchain yay-sayer now?
I am a blockchain yay-sayer. I'm still a little bit of a crypto, what is this crypto thing? But,
We'll get you into some of the memes. Okay, why are you here, John?
We can ask Nicola.
So solving
Can you ask the question again?
So solving some of these problems, what you mentioned, were too difficult to solve before. So Avalanche, in my opinion, has one of the best enterprise partnerships, business development arms. I'm not just saying that because you're here. But anyone with a problem that's trying to solve it on chain, I often refer them to Avalanche and what you guys are doing, because you are very, very interactive. You're highly interactive with your partners, and Maybe for the audience, you can dive into a little bit as to why an L1 is sitting on this panel with a custody, tokenization, and banking partner.
Absolutely. I mean, we work closely with everybody on this panel and most people here. So I'll take a step back. And the way I like to frame this is I think you've seen on the blockchain side, on the technology and infrastructure layer side, I think you've seen over the years, first, second, third, fourth, fifth, and however many generations of blockchains that improve the technology incrementally on the margins. They're a little bit faster, a little bit cheaper, they're a little bit more decentralized, insert whatever special feature they have. And their products technically have always been their token, and then they use that token to go and find users and use cases and product market fit. They're effectively a solution in search of a problem. Where Avalanche is different is we have our own public permissionless layer 1 blockchain. But what Avalanche really was built for, from day one, the vision was tokenize the world's assets. And in order to do so, Avalanche has the ability to launch your own custom or purpose-built blockchain. So effectively, Avalanche is the blockchain platform for businesses, whether governments, including governments, institutions, asset managers, enterprises, innovative startups that want to launch with a blockchain as their digital backend from day one. We allow for that. We've worked with governments and institutions across the world. So if your asset class or your business is requiring certain jurisdictional requirements, you can bake that into your own blockchain. If you have compliance or KYC or AML requirements, you can build that into your blockchain. If you want a permissioned private chain, which effectively is what a bank is, right? Or a permissioned public chain, which is what enterprises really are, or a public permissionless chain, which we see more on the crypto side, we have the ability to spin up any blockchain to serve any need built for the business purpose or the asset purpose. So when you say are all banks going to effectively be on a blockchain, I don't see why not. In the same way that blockchains went online 20, 30 years ago, they're going to move on chain. It's just a replacement of the technology backbone that allows it. I don't think that current blockchain technology solves for that because it's much more a religion than a solution to a problem or a business. For most ecosystems, we like to say, well, we provide the technology that allows your business or your use case to scale. So every account at a bank is effectively a wallet, right? Every bank could be its own blockchain with intra-bank settlements, and then you connect to other banks, and now you have interbank settlements, and now you're effectively recreating an ACH, SWIFT, SEPA, Fedwire, name your international coalition or consortium. It's just a faster, better rail.
Can I add something? Because I'm a part-time Avalanche salesperson. So we recently...
I owe a lot of people money after today.
We recently filed for, well, recently, it took like 2 years, but whatever, for an application in the European Union to get something called a trading and settlement system that basically allows you to use a blockchain to settle securities trades, eliminating the need of a central securities depository, which is the layer that a blockchain... Is Talia still here or not? Because this is the layer that a blockchain disintermediate, which is the central securities depository, because their role basically gets eliminated by using a blockchain. And we did the filing with using Avalanche, demo the whole system, et cetera. To get a license, you have to have something working. And one of the things that Avalanche has that is interesting for securities regulators, and this was with ESMA in Europe, is that it has deterministic finality. In other words, when you move a transaction and you put a new block on the chain that closes a transaction, it's final, and nobody can touch it. And so there's all the blockchains that have probabilistic finality. So it closes, but the block can be reorganized, or it can happen later, have to settle on another chain later, etc. And that actually, has advantages in some respect, but for securities, it creates a problem because maybe you've registered a transaction of a security, which could be as, we were talking here about billions of dollars, and then suddenly, like a few hours later, a few days later, you have to unwind it. So these are things that, as the institutions are taking over, that these things become more relevant, right? Like the specific features about how this underlying infrastructure work to build real applications in capital markets become much more important. So.
Okay, so I guess back to the title of this, we'll touch on institutional lending. I think one of the bigger breakthroughs on BIDL was its acceptance as collateral, and we talked in the last panel about looping a CredX on Morpho for 8% and being able to finance a private jet in that facility. And then, but I do think, BIDL is at the moment a very widely distributed product. And again, similar to ACREDX with a great backer in Apollo. BlackRock. It's
By the way, we were the ones that tokenized $150 million of ECRIT before the ECRIT X
Correct.
version happened.
Correct.
And it was already available in Lufscale, in Solana, and Camino, and like many other lending protocols. Whatever you heard in the previous panel is not news. So
it's Securitize.io is the. So we're going to get the credit.
no, we don't do it in our own protocols. We integrate with DeFi protocols that are adapted to permission assets, because obviously RWAs are permissions.
But again, I think going back on the lending side, the BIDL product has been now. I don't know the exact figures, but it is widely accepted as collateral in the lending market. Maybe you guys can touch on that a little bit more in terms of, again, for the audience, give me an idea of what type of yield you're generating from that, what the borrow rates are on this type of product, and again, how simple is it to actually, who can I go to actually, would be a Copper and a Sygnum, for example, to be able to leverage these new markets?
So there's two collateral use cases for, let's say, BIDL or ECRIT or any tokenized asset. One is I'm on a derivatives trading, and then I post it as collateral instead of posting, let's say, stable coins. And because these are tokenized treasuries with a large asset manager behind, and they offer a yield, then first, your collateral is earning a yield while you're posting the collateral, and second, the collateral has higher quality, and therefore you can actually borrow more on the derivatives trading exchange to do it. And both, Sygnum and Copper, they both do that thing, and we work both with them. And there's other kind of collateral, which is I'm going to borrow against the asset to lever the asset, which is not necessarily works well for treasuries because of the yield is lower than the lending rates, but it works well for other assets like, let's say, ECRIT, where ECRIT has 10-12% yield, and if you can borrow stables at 6%, then you can lever the asset because you can just buy more of the same and amplify the yield. And the first Morpho integration that was done with ECRIT like a year ago, we amplify up to like 18%. So those are kind of like two different use cases where both is basically taking a collateral that is a real world asset that has higher quality than the traditional collaterals that have been used in crypto that are either stable coins or digital assets that are very volatile, and therefore the loan to value is very, very low. So, and then
maybe I can add just to specifically from a bank's perspective, right? The key theme for which we're excited about more things moving on chain is a key topic of growth for us, which is the off-exchange custody. I'm sure you can also touch upon it. It's that this, let's call it the segregation of state and church also in the crypto and digital asset banking ecosystem, namely that custodians are custodians and exchanges are marketplaces where you go and trade, and you want to leverage a custodian's technical, procedural, but also legal setup that you can remove the counterparty risk of the marketplace. That means the exchange. And in Switzerland, for example, as a bank, you have to make sure that these assets, be it on-chain or not, that they're off balance sheet. And as a result, for the particularly institutional clients that are coming in, they have a huge benefit. And this can be done in different ways. You can do it with US Treasuries completely not on-chain. And you right now see we're integrated with various exchanges. Some accept only crypto, some accept crypto and US Treasuries, some accept crypto US Treasuries and BIDL and other tokenized money market funds. And the key difference, or one of the key difference between doing it with the US Treasuries versus doing it on-chain is exactly moving, or let's say the more we can move both the cash and the collateral on-chain, the easier it gets to reduce the trapped collateral as you outlined, namely that you can also, it's 24/7, so you can recollateralize, you can cross rebalance between exchanges or during the weekend, which in traditional finance is simply not possible. And so we see year after year this whole, let's say, liquidity management becoming more efficient, and I think we're only just getting started. Last point I want to make is what is interesting is that actually the exchanges, at least for those that use this product for crypto trading, they're a bit the kingmakers of which such on-chain assets are allowed. So a lot of the discussions, I'm sure Carlos and also I and other gentlemen here, we all have is exactly which exchange accepts which collateral as off-exchange. So they're a bit the kingmakers in this whole process.
And how have they historically, in your interpretation, how have they historically decided the exchanges?
It comes with liquidity. What is my liquidity? What is my ability to turn that thing into the cash I'm going to need, or the stable coin I'm going to need to pay off?
Like they use them interchangeably now. That's nice.
You can, right?
Yeah.
It is. And I think, this part of the catalyst that has really increased awareness about this, especially for the derivative trading use case, is interest rates actually matter now. 3 years ago or 4 years ago, rates at zero in ZIRP, you don't care that you're not earning interest on your collateral. But now, in order for the trading venues in the native crypto world to compete with the CME and other more established clearinghouses which pay interest on deposits and which allow for treasuries to get posted as collateral for initial margin, these new the trading venues need to compete so that you're getting the same return, same effective return, and not having to pay that interest rate drag. So I think that that's also a key consideration is the clients need to be earning a healthy yield, which comes from products like BIDL, treasuries, right? It needs to be safe and liquid for the trading venues to assume that it's going to be good collateral. And then it needs to be relatively freely either transferable or turned into a transferable instrument.
I'll tell you one thing that Bill, who the CEO, the founder of Jump, who is actually here for the first year, I was just having coffee with him. He told me like, I don't know, like a year ago or something like that, something that kind of resonated very well with me. He said, look, Jump does trading both traditional assets and crypto assets, right? They do market making in both. And he said, in the traditional world, I have very high quality collateral because I have treasuries, I have a money market fund from JP Morgan, etc. But it moves very slowly. And I cannot borrow on the weekend or etc. And in crypto, I have very fast rails for moving collateral very fast, but I have very bad quality collateral because I have to rely on stable coins that they peg or on crypto assets that are very volatile, etc. So I see tokenized RWAs as kind of like bringing the best of both worlds, right? High quality collateral that moves at crypto rails and crypto speed. So I think that's very important. Now, the challenge is that if you look at how a crypto exchange operates, the collateral that they accept is also a trading pair on the exchange to liquidate it there if they need to liquidate it. But when the collateral is a security, the crypto exchanges don't have licenses to liquidate within their own exchange the collateral because they can't trade securities. So that has created friction to get these integrations done with the crypto exchanges, and slowly it's moving towards there, be figuring out other ways of liquidating the collateral with on-chain liquidity and stuff like that. But that has been one of the frictions of getting this use case accepted in the crypto exchanges.
I think something that you bring up that's important, Carlos, and I think where the technology really has to help change this is, I mentioned that I think the crypto industry for the most part is still stuck in a first generation business plan problem, and they really haven't moved on from it, right? Custodians are catching up in a good way. Banks are catching up. For the most part, analytics sites, wallets, exchanges, all the business models that currently exist to serve what's been happening in this space for 10 years, right? So added support for a new blockchain, maybe add support for some of its assets. It's an integration fee, it's an indexing, it's all this extra work that needs to be done, and their salespeople are incentivized to do so. But in order to take on this new world with institutional collateral and securities and commodities and a million other different assets, you're going to need different rails, right? You're going to need different licenses. You're going to need different kind of setups for this. And I don't think the industry is really shifting towards that as quickly as they should. So you have outliers that are really taking the next step to build better products, institutional products, supporting the institutions that are coming in the right way. And I think maybe with or without the Clarity Act in the US, which should help. But for the most part, there's still opaqueness there, and there's still this old mentality of thinking that is not as supportive of this next leap forward at the technical and infrastructure layer.
Who are the ones that are doing it well, in your opinion?
I won't answer that right now.
That was an easy tee-up to just mention the names on the panel.
Well, no, I don't mean you guys, but I mean just in general, when I look at like five analytic sites, and every single one has a completely different metric for how much value or how much in stable coins or how much in tokenized, like every single one uses a different methodology. And then you go and ask them to fix this or to correctly support it, and then they come to you with an integration fee or an fee. Like, right, exchanges are the same way. They support your blockchain, but if you're a private blockchain or a permission blockchain or an institutional blockchain, like we have FIFA has a blockchain on us, and they're doing collectibles, and they're going to do payments, they're going to do ticketing, they're going to do all these things. Well, now FIFA has to go to Binance or Coinbase or any exchange and be like, hi, put me in the back of the line, or I'll pay you more to put me in the front of the line to support my blockchain for my assets. Like, the world is not going to wait for the exchanges and the infrastructure providers to continue being the gatekeepers from allowing people access to the assets that should have always been and are coming on chain now.
I think a few World Cup tickets would would suffice.
You'd think so.
I think FIFA knows how to get decisions made in their direction. That's something I've learned.
That's true.
They have a history of.
So I guess rolling into that a bit. So banking on blockchain. If Mathias and Sygnum came to you and said, we want to build our own private label chain on Avalanche, what does that even look like for actually from your perspective, and then maybe from your perspective once you hear what he says?
I mean, we do this work with banks right now and asset managers, and we do it. We did something similar with a consortium of 5 banks in Saudi Arabia under the guidance of SAMA. They needed a permissioned private chain. We provided that. All the nodes had to be located in the kingdom. We can do that. First, I'd ask, what are the compliance requirements that are needed, right? How many nodes do you need? So there are multiple third-party providers. Ava Labs has one as well. That is blockchain as a managed service. People like to think blockchains are now so difficult and they take 3 to 5 years of R&D for an incremental improvement. It's really not that difficult anymore. We've commoditized it. You can spin up a blockchain in 5 minutes if you really wanted to. That's pretty basic. So first things first, what do you need? Right? What performance measures do you need? What kind of decentralization, distribution of nodes do you need? What's the jurisdiction requirements? And we can work through that rather easily with the solutions architecture team and spin up a chain with whatever gas structure or no gas structure, fee structure that's wanted, and just stand that up in the course of several days or a couple weeks.
And for you, is it a technological decision, a regulatory decision? I assume a bit of both, but how do you think through that scenario?
Yeah, first thing is probably the technological decision is, of course, important, but it's a bit, probably 10-20% of the equation. The rest is really how to integrate that part into the overall banking infrastructure that is still needed today, integrations and ultimately for reporting to the national bank, reporting to the regulator, the core banking system, the link to the fiat system, the ledger, how do these systems talk to you, how do you make it from a UI standpoint that people don't realize that you're basically, still converging, managing the convergence of two worlds, because today we are not yet fully on chain. Not everything is on chain, so we need to manage both. So that will be a key consideration. And then, of course, that's why you said the word compliance 4 times in 30 seconds. That's obviously a core consideration. And the regulatory part, probably we would spend 50% of the time trying to work with the regulator to accept that chain and that setup. That probably would be something like 40 to 50%. The technical part 10 to 15%, which by the way speaks for the technological solutions. It's not that complex anymore. And then the rest is integration in the other systems. So
I mean, we do this too, though, right? Like, we're not just out here talking about the merits of the technology. We work with the institutions as well, and we work with the regulators as well, right? We constantly have to do education to explain that on-chain is not that different than online. Right, and the same things can be built in at every level.
On-chain's a new database.
That's
what it is.
I mean,
I think Christina mentioned on the previous panel, right? I think the biggest issue is that what we're talking about here just put the entire audience to sleep, right? Compliance mentioned 4 times, regulators. It's like, that's not what people came here for. This is crypto, man. Where's my Lambo and my laser eyes bull? Like, this is what happens when you get traditional finance, banking to come onto blockchain, and what do you have to consider? And I think it's the reason that some of this hasn't taken off so far is because it's the unsexy part of finance. That's what blockchain is the underbrush. We're not the frontline traders that are, mine-yoursing $1 billion up markets, but we are the settlement rails that allow a lot of finance to occur, and that takes time, patience, attention to detail, things that, in my brief experience in crypto, doesn't come culturally to crypto native because spreads have been wide and returns have been high. And so, do I need to be precise? No, because am I going to make 25% or am I going to make 23%? That's not important. I'm going to make a giant percent. And
but I'll say it's both, right? Because I will make the argument that at how many times is retail, for the most part, who's been involved in these cycles, going to keep on coming back to the same well and leaving thirsty? Like, you can only extract so much from retail over and over and over again. And I don't know anything in history that's been that super fun and exciting, that's moved that much. It's the boring stuff on the background that sets the foundation for the cool stuff to be built, right? If I was to ask anybody in this audience or here today, like, what's been the killer app of crypto over the last 15 years?
Speculation.
No, but name an app. One does not exist. right? We have not yet had an aha moment that has delivered a new product using the technology. We just make everything better that currently exists today. We don't have the email moment for the early days of the internet or social media for Web 2. We have not done that because it's been highly speculative and not delivering that value.
But arguably, tokenization is an app or a use case.
Exactly.
Yeah, stablecoin is tokenized money.
Stablecoin is tokenized.
But you're not going to
Tokenization broadly
put BlackRock's BUIDL and bank settlements and deposits and exchange and all this stuff alongside meme coins and NFTs and God knows what the newest thing of the week is, right? Like at some point, every institution says to us, we are more than happy to go on chain, but we don't want to be validating activity that could be illicit, illegal, or sanctioned with other people. And you don't have a solution for that. Or sorry, you, the industry, has not had a solution for that. Well, that's why you silo everybody into their own flow and you make it interoperable.
I don't know, but the internet also has illicit and licit activity, and people use the internet, right?
True.
I mean, as far as they're segregated.
But nobody's like a bank is not using the same server as like an online casino.
Not the server, but the same rails, right? Like.
Wow.
So reputational preservation, I suppose, is a bit of a concern for the traditional folks coming in.
It's been true. Like I mean, we did the first high-profile tokenization project. We did with Avalanche, and coincidentally, when we tokenized KKR. KKR was like the first asset manager decided to come on chain and tokenize that. And guess what? The next 2 weeks, my phone and my email was blowing with like people wanting to do that. And then, then Terra Luna happened and Celsius happened and BlockFi happened and FTX happened. And then it completely evaporated because the answer was, we don't want to have any, reputational impact for being in the same industry where you have like people, being taken custody with, handcuffs and going to throw in jail or
no banker wants to wear orange jumpsuit.
So nobody wanted to touch it. We actually had with one of the top 3 banks a project already about to be signed, and the chief strategy officer, he called me and said like, we're canceling. The bank has prohibited any interaction with anybody that touches anything in this industry. Period.
I mean, that's.
And I worry, by the way, with the new wave of tokenization and all these shenanigans happening on some people doing clearly illegal stuff with tokenization, that the same thing will happen again. And we don't seem to learn as an industry anything from the past. So.
Yeah. Well, this is, 8 years later in crypto, I tell folks, what do you do? I'm in crypto. You still get the head tilt still.
Do
you say finance?
No, I tell my friends I work for a blockchain fintech. I do not work for a crypto company.
I say,
and actually, that is mostly
crypto,
true.
Hard C on the. I'm crypto. I like the little bit of fear that glazes over them when you say it. All right, we've got a minute left. What's the newest bit of information or news that you think is enormously impactful that maybe people hadn't necessarily viewed as such in the last 3 months? Give me something that you think is just incredibly important that this audience should know that maybe they brushed over.
I don't know if people brushed over it, but what I've noticed, and it's not a piece of news, but the increasing use of the word privacy whenever somebody's talking about both crypto or blockchain, I think is really interesting because it is so antithetical to the initial reason for blockchain, right? Sunlight is the best disinfectant, kind of transparency of all activity that happens. And I think collectively, the ecosystem is realizing that there are use cases for privacy, right? That this is a spectrum of, there are times where everything transparent is great, and there are also times where none of us here are going to publish our Chase bank account balance on the internet, right? I'm not leaving that open for everybody to see. It's a very small number, by the way, so it's because I'd be embarrassed. But I think that's something that has, I think, been a little bit of a sea change that people may or may not have realized.
So from my side, I think there is one article that Hester Peirce, which is arguably the most crypto-friendly commissioner on the SEC for the last 3 commissions. She published an article that the title is "Tokenization is enchanting but not magical."
Yeah.
Which she basically said, don't think that because you use the word tokenize whatever, you can just like do whatever you want with securities. Tokenized securities are still securities. Tokenized derivatives of securities are also securities, and you have to still comply with the law. And this comes from the most crypto forward friendly person in the commission. So tokenization doesn't change the nature of the asset, it just gives better rails for the asset, and that's it. And anybody that tells you differently is just...
She'll be coming down to visit us in Miami in the end of the month.
I know, I'm actually speaking at the same conference.
Yeah. Very good.
I think in short it's that because it's not in the news, I think if you speak to people here throughout these days, I think the general public and also maybe even us here, we underestimate how much is happening behind the scenes. All of us doing collectively with institutions that have taken the strategic decision to go in and embrace this technology, but are maybe a bit slower. It's a 12 to 18 months kind of cycle that then will accumulate over the next, again, 6 to 12 to 18 months into a massively increased network of trusted nodes that can interact with these blockchains in a meaningful and obviously a legal and positive manner. So I think that's underestimated. Last year, people were maybe a bit too bullish, and this year I feel maybe the opposite could happen a bit less.
Healthy skepticism, which is good.
Yeah, which is a good thing. Yeah.
Yeah, strong close, John.
Jeez. 3 months is like 3 years in this industry, so I can't even think that far back. But I would agree with Amar that I think the rise of the importance of privacy. I think the signaling that rules exist and you can work within them, and the ability to do so. I think someone was speaking about this earlier today, that private blockchains are going to start to come back, but they're going to come back because they're connected to public blockchains. And that interplay is really, I think, going to drive us forward across different asset classes and different jurisdictions. I think we're just at the cusp of that, so exciting times ahead.
Wonderful. Thank you, gentlemen.
Thank you.
Thanks, Mike.